Hello and welcome to a look at calculating the expected return of a portfolio with the capital asset pricing model with me, Andy Duncan, here at FinLingo.com. The capital asset pricing model, or CAPM, from modern portfolio theory provides a really useful chart called the Security Market Line. The x-axis is something called beta. This is the calculated risk level for any particular portfolio. The risk level of what's called the market portfolio is always defined as being 1. For example, in the United States, the market would most likely be defined as the S&P 500 index, which represents the 500 largest companies. The y-axis is the expected return of any stock or portfolio. And we typically already know two major things. First, we'd know what's called the risk-free return, which lies on the chart where beta equals 0. This would get defined as that investment which, as the name might suggest, had zero risk. Most likely in the United States, and for US dollars, that would either be a US Treasury bill or the latest on-the-run US Treasury bond. Your mileage here might vary. Let's say this had a return level of just 2% per year. The general market return would also have a known expected return. For example, let's set this to a simple 10%, just to make the mathematics fairly easy. We've already defined beta in one video and then calculated it in a second video. If you want to see what beta is and how it's calculated, then you might want to watch those two videos. But if you're good with beta, we'll just continue on here. The important thing to remember is that the market portfolio is always defined as having a beta of 1. So what if we have another target portfolio, one which has a beta of say 2? What would its expected annual return be? Well, using the security market line, we can always figure out a good approximation. In our case, a portfolio with a beta of 2 would get an expected annual return of 18 fantastic %. So how did we work that out? Well, we did it using an equation which directly generates the actual security market line. Here's that equation. The expected return of the target portfolio is equal to the risk-free return plus the beta of the target portfolio multiplied by the difference between the market's expected return, take away the risk-free return. It might sound much more complicated than it actually is. But if you can remember this equation, you'll be able to answer key questions in any CFA exam. So let's have a crack at a question in FinLingo. Here we're supplied with the risk-free return, the beta of the target portfolio, and the market's expected return. Let me note them down, then I'll plug them over into a cunning Excel spreadsheet. So the risk-free returns equal to 2.39%. The supplied beta of the target portfolio is 1.82. The market's expected return is 10.24%, and then we copy the risk-free rate over to here. Next up, we take 2.39 from 10.24 to get to a halfway house of 7.85. Then we multiply 1.82 by this 7.85, and this gives us 14.29. Finally, we add on that risk-free rate of 2.39 directly to that 14.29, and then we get to a final expected return for the target portfolio, et voila, 16.68%. Check it out on FinLingo and make sure we've got the right number. And that's pretty much it for the capital asset pricing model and its security market line. Head on over now to FinLingo.com to get an infinite number of questions on how to calculate expected financial returns along with hundreds of other CFA question types. FinLingo. Speak finance fluently.